Good afternoon, everybody. My name is Tony Frigoletto. We're talking to you today from Rivers Edge Wealth Partners in Red Bank, New Jersey. And I want to welcome everybody to our mid-year outlook. Brian Giesen, our Director of Investments, put together a presentation to kind of talk about, how we got here, some of the facts around it, and obviously where we're going. So I'm going to hand it right over to Brian right now, and we can get started at this. Brian, thanks for putting this together, and it's all yours.
Okay, great. Thank you, Tony, and thank you everybody for joining us today. This is our ROOP mid-year outlook. Let me show you the agenda. Pretty straightforward. To start, we'll review market performance year to date. Then we'll talk a little bit about how the economy is doing right now and some of the things that have happened over the last few months. And then we'll close just talking a bit about what we expect for the rest of the year. And as we kind of, start to think about, early thoughts on next year. So let's get into it. So the first question, how have markets done so far in 2025? I think if you look at the full 6-month picture, markets did pretty well in the first half. Stocks were broadly up, both here in the US and internationally. Bonds performed as expected. They were a nice, offset when things got a little choppy with stocks and gave a low single-digit return for the 6 months. And we finished the month of June with most of the US indices hitting new all-time highs. That all sounds great, but it certainly didn't always feel that way along the way. The markets had a lot of change and a lot of volatility to deal with. I think March and the early part of April were particularly choppy and really rough for the stock market. But if you were able to hang on and ride out the weekly volatility and some of the daily headlines, investors were rewarded with some pretty good returns for the first half of the year. So to start, just wanted to discuss a few of the events that we think really shaped the first half of the year, but also are going to impact the second half and as we get into 2026. So maybe starting from the top, we had a new administration. This is the second term for the Trump administration. I think in some ways, he's a known entity by now, but yet he still continues to surprise the market in many ways. I think right out of the gate, it's fair to say that the Trump administration was more prepared and focused this time around on what they wanted to achieve. And so we really saw a flurry of new regulation, some fast progress on new legislation, and really just moving forward at a quicker pace than I think they did really in 2017, the first time around. But nevertheless, the market really did well in the early part of the year, but it really wasn't until late February when a Chinese artificial intelligence company called DeepSeek, you may have heard that in the news back then. What they did is they released a new AI model that rivaled pretty much everything we had here in the United States. And I think the market's perspective, that kind of challenged some assumptions it had, particularly in the technology space. I think up until that point, the idea was that China and other countries that maybe don't have access to the latest and greatest semiconductors wouldn't be able to create artificial intelligence products that were on par with what we're doing here in the US and other countries. But they were able to show, even without the best semiconductors, they were able to do that. And so, that caused particularly the technology space, the NASDAQ index, the Russell 1000 growth really to turn over in late February. I think the big one on this list right there in the middle, the fluctuating trade and tariff policy, caused quite a bit of volatility in March, April, and it really continues on today, yesterday. The original April tariff deadline got pushed back to July, and now this week, now is pushed back to August. So I think it's kind of kicking the can down the road a bit on some of this volatility. I do think kind of the daily market reaction to a lot of this has lessened, maybe for a couple of reasons. One, I think the market's been conditioned to expect that things could change and they could change tomorrow, so it kind of stopped overreacting to every headline. And also, I think the market sees through some of maybe the daily noise and thinks that down the road we will get to a more rational, perhaps thought out trade policy. So it doesn't sell off quite as much on daily headlines. But admittedly, it got a little scary there in April when we for instance, we put 150% tariff on our largest trading partner. But I think we've kind of moved past sort of that peak tariff uncertainty period for now. I have escalating turmoil in the Middle East as the fourth one, but I would really say, we have several geopolitical conflicts and wars, across the world. The Russia-Ukraine war continues on now for the third year, which is kind of hard to believe. Israel and Palestine continue to fight. And then in the second quarter, I think the U.S. took a big step and bombed some of the nuclear capabilities within Iran. All of these, I think, are a shock to the market initially. But even though all of these things are horrific for the people involved and humanity and kind of everybody, the market does tend to have kind of a short memory. And I think it was able to kind of move on and move past a bit all of these things, pretty quickly. And then finally, most recently, a budget and tax bill in Congress. Over the weekend, the president signed it. So Congress has now passed a budget reconciliation bill that largely extends the tax cuts from their 2017 budget reconciliation bill. I think this is something we'll be trying to understand and digest for the second half of this year. But also has wide-reaching impacts on the tax code, social programs, subsidies to certain industries, and many other areas. So as we kind of all learn and read what's really in the details of this thing, I think that will be something that the market will be focused on in the months to come. Taking a look at the actual returns in the first half of the year, all the major market indices had a good start. There's lots of green on this chart, which is nice to see. U.S. stocks, starting on the left-hand side, were broadly up mid-single digits. The S&P 500 up a little over 6%. The Dow Jones up 4.5%. Russell 1000 value and Russell 1000 growth. So that's large cap value, large cap growth. Both of those up 6%. And then the NASDAQ composite index up just a hair under 6%. I think the real outperformance year to date has come from outside the United States. I think it's been a little bit since we've kind of seen this sort of outperformance versus the US. The MSCI EFA index, which represents developed countries outside the United States, was up almost 20% through the end of June. And the more developing parts of the world, the MSCI Emerging Markets Index was up, about 15.5% through the first 6 months of the year. I think there were a couple reasons for maybe why outside the U.S. outperformed so far. The first is, for many of the reasons we just mentioned, some of the turmoil in the United States caused investors to start looking outside and elsewhere. If I think about Europe, there's still some pretty decent growth. There's some countries that are coming out of recession, a little bit less volatility, maybe a little bit less political noise. I think investors started to look maybe in countries like that or in regions like that. And the second reason is the strength of the US dollar against a basket of all the other major currencies, the euro, the British pound, Japanese yen. In the first half of the year went down 10%. So the dollar got about 10% weaker. And that stinks for people that may be traveling abroad. But if you own stocks outside the United States, when they get translated back into dollars, that's a good thing. And so what we tend to see over time is stocks outside the United States tend to do well and often outperform the US when the dollar is getting weaker. On the right-hand side, maybe to cover bonds a little bit, I'd point you towards the bottom third of that. If you look, the US aggregate bond index, which is the major bond index for investment grade bonds, year to date through June was up 4%. Corporate bonds, a little more credit risk, was up about 4.25%. And high yield bonds, or what we used to call junk bonds, are up about 4.5%. So all in all, a pretty good start to the year across both stocks, US, international, and then bonds of different sorts. This is a daily tick chart of the S&P 500 for the first 6 months of the year. I mentioned it was up about 6.2%, but that's certainly, we didn't get there by taking a nice 1% gain each month over the 6 months. In fact, it was really a completely different picture. In late February, right around that DeepSeek artificial intelligence product release, the market started to sell off. And as some of the tariff narrative started to pick up in late March, the market really started to sell off. And so between the peak in late February and the first week of April, the S&P 500 dropped 19% in about 6 weeks, really hitting its bottom, I think, around April 8th or April 10th, something along that. And so I took a look back, and that was the quickest sell-off, 6 weeks of this magnitude since the early COVID, call it panic, almost 5 years ago in March of 2020. Thankfully, the sell-off was short-lived. I mentioned we bottomed out in that first week of April. And then as we got to kind of mid-April, we really started to march upwards. And the S&P 500 recovered about 25% in less than 3 months to hit new all-time highs. So a pretty steep drop, but then a quick and healthy recovery to get back to new highs in less than call it 4 months. I spend a lot of time talking about the S&P 500 just because it is the major equity index that most people follow here in the U.S. And we just showed you kind of how we got the 6.2% in the first half of the year. I do realize that not everyone is willing or wants to ride through that type of volatility for a number of reasons. And as we think of clients' portfolios or even investing ourselves, I would think the worst case scenario would be someone who's invested in all equities or near all equities and really can't handle that type of volatility. And so they throw in the towel in early April, lock in a double-digit loss, and then they're not there for when that quick recovery happens and you hit the new high. And so in the first 6 months of the year, I think diversification across different types of asset classes within a portfolio really showed its benefits. So in this chart, the purple line is the 6-month S&P 500 return. The blue line is the MSCI EAFE, so the international equities. And then the orange line is the US aggregate bond index. And so you can see for bonds in that orange line in the middle, bonds never really went negative all year. So even during all of the disruption in March and April, bonds actually started to climb and get higher. International stocks in blue did dip down, call it -4 to 5% for the year, kind of in early April. But for most of the year, international stocks have been outperforming the S&P 500 by quite a bit. And so a good part of our job is to understand, a client's and a person's risk tolerance and kind of unique needs, and then try and construct the right portfolio to meet those. And in many, many cases, I understand some people being all equities or all S&P 500 makes a lot of sense for them, but I know for many people, finding that right mix often involves, using a blend of both different types of stocks, different types of bonds in order to kind of meet the right target return while also lowering volatility. Okay, let's jump to how the economy is holding up right now. And I think the main takeaway is that the economy is holding up pretty well. I think things are okay. So we've talked about there's certainly been a lot of uncertainty introduced. I don't think we're out of the woods yet, but the economy has been able to weather it so far. And I think that's one reason why we've seen the financial markets recover so quickly and have done as well as they have year to date. As we think of the economy over the last few years, I think it's impressive and remarkable just the resilience and the durability and the strength that the economy has shown given everything that's been thrown at it, call it from 2022, forward. And so in this section, I want to draw a distinction between survey data and confidence readings and actual economic data points, because I think they kind of paint two different pictures about how the economy is going. Survey data tends to capture how businesses and people are feeling right now and how they currently view, the prospects for the future. And then so-called hard data or economic data shows how the economy and businesses have actually performed. So starting with some survey data, and I don't want to get too far in the weeds in this, but on the left-hand side is something called the ISM Manufacturing and Services PMI. So that's Purchasing Managers Indicators. And so what these are surveys that measure new orders, production, inventory, and other factors across several types of businesses. And so there's two of them. There's manufacturing in blue and services in black. And the point I wanted to get across is if a PMI reading is above 50, that means things are growing. And if the PMI is below 50, that means the economy or that part of the economy is contracting. And so you can see in the blue line, manufacturing in this country has been contracting for several years now, but it's really services in the black line, which represent, about 70% of the economy, has been the thing growing and really driving the growth of the economy. In the most recent reading, services PMI dipped into contraction territory, so below 50, amidst all this uncertainty. If I look back into 23, 24, we've seen dips, a reading or two dip down into contraction territory before. I don't think it's necessarily indicative of a certain downturn, right? But it does indicate that, businesses and purchasers are starting to feel the heat a little bit and maybe are pulling back slightly. On the right-hand side, these are two different measures of business confidence. So the black line shows CEO confidence, and the blue line is a reading of small business confidence. And I think both of these kind of tell the same story. As we got into, March and April, both CEOs of probably larger companies and then small business owners started to lose confidence in the spring. I think that, I do see both of them are bouncing back. And when we get the next reading, I'm sure we're going to see a bit more recovery, but I think this makes sense and rightfully so. If you're running a business, it must be difficult, when the rules keep changing, and, it must be very difficult to kind of forecast what your costs are going to be in the future because you don't know what they're going to cost, what tariff might be, and also what impact that might have on your sales. So both purchasers, business owners, small business owners, all, confidence certainly took a hit in the spring. On the consumer side, I think it's fair to say consumer confidence was shaken as well. This chart shows the Conference Board consumer confidence reading in blue. The black line is the University of Michigan consumer sentiment indicator. Both of these are probably the two most widely followed measures of how the consumer is feeling out there. And, very similar story, in that kind of March to April to early May period, consumers got scared and these confidence readings came way down. As I mentioned, consumer spending is a huge part of our economy. So when people do get spooked and start to pull back on spending, that naturally can have an impact on economic growth. We did see a little bit of this in March and April in some of the more real-time economic data we get. And by that, I mean airline purchases, hotel reservations, even restaurant reservations. Those did start to dip a little bit in the month, but thankfully we are starting to see that recover a bit as kind of the economic picture has calmed down a bit. If you move over to kind of some of the more hard data or economic data releases, I think it's fair to say growth estimates have been impacted by the tariff uncertainty, but the market is still expecting pretty good growth over the next couple of years. On the left-hand side shows the U.S. gross domestic product, or GDP. That's the main way we measure output or growth here for the economy. You can see in the last 3 years, the economy's kind of grown in that 2.5% to 3% range. But as we now look out into this year and next year, what started the year as an outlook of maybe call it 2% growth for this year and next has now come down into that 1.5% to 2% range. I think if we get a bit more clarity on a tariff policy, or if it's not as punitive as maybe the market is expecting it to be, I think it's possible maybe some of these estimates, particularly for next year, start to climb back up towards that 1.75%, 2% range that maybe we were closer to at the beginning of the year. On the right-hand side, this is corporate earnings growth for the S&P 500. A similar story. At the beginning of the year, analysts were looking for double-digit earnings growth for both this year and next year. And as really the second quarter has played out, those estimates have come down a bit, where for this year, analysts are expecting closer to high single-digit earnings growth for 2025. And as we look into 2026, growth has gone from kind of 13, 14% for next year, now down to 10. I think tariffs, if they are implemented in whatever fashion, I think they are going to have an impact on growth. That's kind of the consensus thinking. And particularly if they're implemented over an extended period of time. But at least where we sit right now, I don't think it's going to be drastic. Growth may come down a little bit, but particularly as we start to think about next year and maybe the year after, I think it's really more of a one-time hit to growth and kind of be baked in as we start to look at growth in 2026 and beyond. Moving over to the job market, I would summarize it just things continue to look pretty solid. On the left-hand side, this is monthly job growth from the Labor Department, and I put in the orange line, which is a 3-month moving average. It looks like the economy continues to create about 150,000 new jobs each month, and that remains a pretty solid pace of job growth. When we saw the June labor report last week, the unemployment rate ticked down to 4.1%, and the most recent report on number of open jobs was about 8 million unfilled jobs, and that was actually up from the prior month. So, job growth looks pretty solid. No real worries there. On the right-hand side is unemployment. I mentioned the national average unemployment rate is 4.1%. This shows the weekly unemployment claims that get released every Thursday. People follow this because this is often a leading indicator of where the job market and unemployment is going. I pulled this back, I think, 4 years. And you can see for the better part of the last 3.5 years, we've kind of been in a range of 200,000 to 250,000 new unemployment claims each week. which is a historically low run of unemployment. Things can clearly change quickly, but again, like as we sit here now, the job market remains pretty solid and continues to show continued strength. And then finally, this is a chart. I think I show this every time. It's the Consumer Price Index, or CPI. This is the main way we measure inflation here in the US. And as you can see, coming off that high in the middle part of 2022, we continue to tick lower and move closer to the Federal Reserve's target level of price increases. The most recent reading in May showed that the headline CPI grew 2.4% year over year, and the core CPI, which excludes food and energy costs, increased 2.8% year over year. So as a reminder, the Fed wants us to get down to close to 2% over the next, call it 18 months, 2 years. And right now, if nothing changes, I think we're on a good trajectory to get there, fairly soon. The big question, though, is whether tariffs and however they're implemented is the impact of that going to start showing up in prices, and is this steady decline in CPI inflation going to stall, and do prices start to rise at a higher rate? We haven't seen it yet, in the April and May number. I think we get June in a week or two, but it's really something that I think will play out over the summer months. Whether the impact of tariffs will start to show up in the inflation data. Okay, in the final section, you talk about what do we expect in the second half of 2025. I think we are cautiously optimistic about the second half of 2025. I feel we entered the year with some momentum and strength in the economy. It got off the rails for a little bit, but I think things have calmed down. Having said that, I don't think anything would surprise us. So we are kind of taking the expect the unexpected posture. We have pretty much everything on our bingo card for the second half of this year and even into next year. And as we think of kind of what to do with portfolios, I think we'll continue to take a more balanced posture in that sense, and not get too aggressive and over our skis in case the markets get choppy again. But at the same time, we still do want to stay fully invested with enough exposure to the growth assets in the portfolio in the event that this bull market continues to keep running. So in terms of market scenarios for the stock market, I wanted to quickly revisit this chart that we showed you in January. I think at that time, we thought the base case in this chart was the most likely. I think at that point, we had it at about 65, kind of tweaked these slightly. But overall, despite what happened in the first half of the year, I still believe kind of this base case of, call it growth of 10 to 12% for the market is probably the most likely. And excuse me, in terms of what makes up that base case, that includes solid economic growth, whether that's 1.5%, 2%, 2 plus, a continued strong consumer. Wages continue to grow higher than inflation, so that gives consumers a little bit extra money, and we know when consumers get money, they spend it into the economy. So for growth, that's a good thing. Multi-year corporate earnings growth outlook, maybe that looks like 7% this year, 10% next year, or maybe it gets a little better to 8 and 12. But I still think that that's probably still good enough. And I think actually next year is probably more important than 2025. Inflation needs to continue to come down. Sure, it can spike up a little bit for a couple random months. I think that's fine, but really that general trajectory needs to continue to go down. And if all that happens, I think in the back half of this year, we could see a couple of rate cuts by the Federal Reserve. Stock valuation has come back pretty quickly as the market run. But I think there's room where maybe we could get a little bit more slight valuation increase for the S&P 500. For the other, call it like 40%, I've kind of barbelled it and split it between a bear case, a worst case, and a bull case, kind of a best case for the market. On the left-hand side, in a bear case, I think really it starts with economic growth cracking or slowing. Instead of 1.5% GDP growth this year, we start to get down closer to 0, or maybe even next year we slide into a recession. That obviously would not be good for the market. Cracks in the strength of the consumer if they really start to pull back and tighten their wallets. In that case, that earnings growth outlook, we don't grow double digits next year. That kind of comes down to, closer to maybe 5% next year. If inflation remains sticky, or if, the impact from tariffs is more than is expected, and then inflation starts to accelerate, that's not going to be looked, very favorably by, I would argue, both the stock market and the bond market. Geopolitical tensions, mentioned they're already pretty high. It could get worse. I hope not, but that certainly could be, something else thrown into the market. And in a scenario like this, I think the Fed could cut again, but it wouldn't be for a good reason. So if the labor market started to weaken, or if economic growth really slowed down, then I think the Fed could step in and cut, perhaps even more than 1, 2, 3 times, but they'd be doing it because things aren't going well and they need to stimulate the economy. And then finally, on the right-hand side, kind of in the bull case side, this would be if, maybe particularly for next year, if economic growth gets back up over 2% from here. And in that case, the consumer remains strong and maybe even gets a little stronger. Instead of 10% earnings growth next year, maybe that starts to drift up towards 15%. Inflation comes down even closer to that 2% target. And in that scenario, maybe the Fed cuts 1, 2, 3, maybe more, because things are going well and we don't need to remain in this restrictive, posture right now. And, in that scenario, sure, maybe valuation even gets a little bit higher. So kind of to put some rough numbers, in a base case, we're already up, call it in the stock market, 6% for this year. In a base case, maybe we go up another 5, 6 between here and the end of the year, and, call it a 10, 12% year. In a bear case, if things really go sour, we're up 6%, we likely give that back. And then we end the year, with a down year in 2025. And then in a bull case, if things really start to go well, and I would add that, the impact from tariffs, or maybe we get a better tariff policy, or whatever you want to call it, maybe we see the market go up another 10% between here and the end of the year, and we close the year at another kind of mid double-digit equity return, which would be great. This is another chart that I always include. So this is the federal funds rate. So that's the rate that the Federal Reserve actually controls directly, but it influences pretty much everything else in the market. The Fed started to cut rates at the end of, in the back half of last year, but we've been on pause now for a little bit at the current range of 4.25 to 4.5%. I think given the strength of the labor market and, this uncertain impact to inflation from new tariffs, the Fed thinks it's best to wait to cut rates for now. They do have a meeting at the end of this month, but I don't think the market is expecting any action there. But as we kind of get into the September, November, and December meetings in the second half of the year, right now the market, as you can see in the green dotted line on the right-hand side, is expecting 2 to 3 interest rate cuts by the end of December. I think it's fair to say Chair Jay Powell is under a ton of pressure right now from Congress, from the president, from pundits, from pretty much everybody else to lower interest rates. But I really do think he's going to hold firm. He, in his last comments, he really is concerned about potential impacts to inflation. And he wants to make sure he doesn't take his foot off the brake too soon and let prices get out of control again. So I think he's going to hold firm until him and the board feel very comfortable that, kind of any pressure to inflation is behind us. Shifting over to bonds, this chart shows the current yields for several types of bonds in the market. Just a reminder that a yield is the amount of income an investor gets for holding a bond. The blue diamond shows the current yield for each type of bond. The purple line shows the 10-year average, and the black bar shows the 10-year range for the yields of each type of bonds. I think the opportunity in bonds has not passed us, even with them up 4% year to date and 6% over the last year generally. As I look across this, yields still remain pretty attractive across almost every type of bond. If I look starting from the left-hand side, within treasuries, you can get a 1-year treasury bill with a yield over 4% still. A 10-year, I think, is about 4.4%. So, a near risk-free or a risk-free bond still paying north of 4%. A tax equivalent yield on a municipal bond is near 7% still. An investment grade corporate bond, think of a Johnson & Johnson corporate bond, still paying near 5%. And mortgage-backed and other securitized bonds still paying 5%. So yields still look very good. And as we think of what constitute a total return for a bond, there's a couple parts. There's the yield you get, and then there's the potential for price appreciation of the bond. And so given the historically high yields we're starting out, I think within the portfolios right now, we're focused on capturing as much yield or income as we can in fixed income. And then if interest rates do come down in the later part of this year or in the next year, that's great. That'll be that's gravy. That'll be extra return for bondholders. But I think at this point, with everything going on, with tariffs, potential inflation, increasing deficits, borrowing costs, I'm not willing to kind of place a bet that interest rates are going to come down quickly in the near future. But again, they don't have to. We can earn a really good return in bonds from just collecting the coupon every 6 months in most of these type of bonds. The final chart, just kind of want to put this bull market for the S&P 500 into a historical perspective. So the current bull market is the red squiggly line in this series of bull markets. So going back to mid-October of 2022, over the, call it 2.5+ years, the S&P 500 is up more than 80%. Now, there's no guarantees that we're going to keep going up more than we have already. But, as you can see from the kind of shaded gray lines, it's not unusual for a bull market, once it gets started, to continue to run up, meaningfully higher. We do know from history that bull markets tend to run longer and last longer than bear markets do. And the cumulative increase for a bull market is quite a bit greater than kind of the shorter term pain in a bear market. So, over the medium term, I don't know what's going to happen next week, next month. Over the medium term, I wouldn't be surprised to see, this bull market continue for a bit and for stocks to go higher from here. For many of the reasons we talked about, solid economic growth, good corporate earnings picture, a really strong labor market, and inflation that for right now, appears to be under check. Certainly do expect to have some bumps along the way for sure. When we look back at past years, it's very normal for the market to have a few 10% plus sell-offs like we did in April and March in any given year, but still post a positive return for that year. So that's all very normal. But sell-offs like the one we had in the first half of the year certainly don't feel good for anyone, myself included. I've been doing this for a little bit, and I get a little worried, and that certainly doesn't feel good. But we just like to reinforce, we think diversification and taking a long-term approach can help investors weather some of those dips, navigate the ride, importantly, stay fully invested and benefit from the appreciation that markets can deliver, over time. And so with that concludes, kind of the prepared remarks that we had for you today. I don't know if Tony, you want to jump back in?
In any event, I thought that was a great presentation, very informative, a lot of details. A couple thoughts jumped to my mind is one is nothing is free. When you think about where we are year to date and from January until now, regardless to why the market went on the path it has, to know that, we're trending towards a potential double-digit year, just a week after 4th of July, and for folks who stay fully invested, that's the path they're on. So sometimes having some of that pain and being able to just look at the fact that you're a long-term investor and staying invested, that gives you the opportunity to be where you are today versus selling at the lows and buying back at the highs. And the other thing was when you mentioned Chairman Powell and interest rates and tariffs and inflation, one thing we know for certain is regardless to anyone's position on tariffs or even how the policy is being worked out and governed, because we don't run at Rivers Edge, none of us are elected officials. We're just voters. But if there's a 20% tariff on something, or a 30% tariff on something, or a 10% tariff on something, that money is being paid by the person bringing that good or service here, in this case goods, and it's going to our Treasury Department. So the price of that good is higher now, and so that money for whether it be Walmart or Petro, that money is either going to be absorbed part of it by the corporation, which obviously would then potentially reduce their ability to make as much money, so their earnings would go down, or it's going to be passed on to the consumer, where that would drive up inflation because the cost of goods would go higher and potentially change the spending habits of consumers. But what we do know is that tariff doesn't just disappear, that somewhere, somehow, it'll pay, there'll be a consequence paid for it. And whether that's going to derail the economy or not is unknown, but pretty unlikely at this point. But without a doubt, I think that when you're looking at the politics around tariffs and what it does to the cost of goods, or even, Fed policy around interest rates, those things are so much more challenging because we do not know what the outcome will be with the tariffs, because the tariff policy itself seems to be ever changing. So I think it'll be a lot easier to fundamentally discuss the impact on tariffs when there's a tariff policy that's actually in place and more set in stone. But that's all I had to add. I want to thank everybody for listening. If you have any questions about this or any questions that you would like us to answer, you can send us an email, Brian or Tony at riversedgewealth.com or rewp.com, and look for them to be answered during our what we call rootcasts that go out on social media and by way of email. I want to thank everybody for joining us today. Especially I want to thank Brian Giesen, our Director of Investments, for spending the time putting this presentation together. And most of all, thank our clients who have faith in us to help them achieve their financial goals. Have a great summer, everybody. Thanks again, Brian.
Thanks, everyone.